Hook, imagine this, you've just retired after decades of hard work, and you think playing it safe with your money is the smart move. But what if that safety net is actually a time bomb, quietly eating away at your savings? Here's the brutal truth, retirement isn't a finish line. It's a 30-year marathon, and the stock market might be your best ally, not your enemy. Let's unpack why the old playbook on retirement investing is broken, and why you need to rethink everything you've heard, and let's start with the elephant in the room. Why are so many retirees terrified of the stock market? I get it. Volatility feels like Russian roulette when you're living off your savings. But here's the twist, not being in the market could be the riskier move. Inflation isn't some abstract concept, it's a silent killer. At 3% annual inflation, your money loses half its purchasing power in 25 years. So if you're sitting in bonds or cash, hoping to preserve your nest egg, you're actually guaranteeing a slow bleed. That's not preservation, it's guaranteed decline, and now, let's talk numbers. Financial advisors are now pushing 40 to 80% equity exposure for retirees. Wait, 80%? That sounds insane, right? But think about it, if you're retiring at 65 and might live to 95, you're not just funding retirement, you're funding a third of your life. Would you invest in a 30-year mortgage with zero growth? No. So why your retirement portfolio? Personally, I think the bigger risk isn't losing 20% in a crash, it's losing 50% to inflation over decades, and but here's where people mess up, they hear stocks and think get rich quick. No. This isn't about chasing SpaceX IPOs or crypto memes. One advisor in the article called out the danger of high volatility bets. SpaceX lost $500 billion post-IPO. Retirees don't need moonshots, they need durable growth. Dividend stocks, ETFs, and global diversification. Think of your portfolio like a hybrid car, steady momentum with occasional bursts of speed. A detail I find fascinating. Advisors stress income with guardrails. It's not about swinging for the fences, it's about staying in the game, and then let's debunk the myth that your asset allocation should freeze on day one of retirement. Life doesn't stop changing at 70. If you develop a health issue, inherit a boat, or decide to fund your grandkids' college tuition, your plan needs flexibility. A static portfolio is like wearing ski boots to a beach party, it's just not matching the vibe. What many people don't realize is that retirement isn't a single chapter, it's multiple acts. Your 70s might need growth, your 80s income, and your 90s capital preservation. But even at 90, zero equities? That's financial malpractice in slow motion, and now, here's the deeper layer, this isn't just about numbers. It's about identity. Retirees are told to wind down, but your money should be working harder than ever. Target date funds are a great starter kit, but they're not fire and forget. Vanguard's 30% equity post-retirement glide path. That might be too cautious for today's longevity. The bigger question is, who are you investing for? Yourself, your spouse, or your heirs? If you're playing for multiple generations, your risk tolerance skyrockets, and let me leave you with this, retirement planning is the ultimate paradox. You're building a bridge to a future you can't predict, using tools that evolve daily. The old rule of thumb, bonds for safety, is a relic. The new rule. Stay curious, stay adaptable, and don't let fear dictate your legacy. So here's my challenge to you. When's the last time you stress-tested your retirement plan? Not just the numbers, but the assumptions behind them. Because the cost of being wrong isn't just financial, it's the freedom to live the life you earned.